Hi, have you ever wondered why certain currencies have certain value against the other currency, and that why exchange rates are constantly shifting, and different countries have currencies of different value? Well, to understand this, we'll first have to dive into the Bretton Woods system. So, under this system, gold was the basis for the US dollar, and every other currency was pegged to the value of the US dollar. But because this wasn't a very scalable way of measuring the dollar, this system effectively came to an end in 1970 when President Richard Nixon announced that the US would no longer exchange gold for US currency. So, of course, they would have to find a way to value it differently, and let's also look at that in this video. But understanding the Bretton Woods Agreement a little more, so approximately 730 delegates representing 44 countries met in Bretton Woods in 1944, and the objective was to create an efficient foreign exchange system, preventing competitive devaluations of currencies, and also to promote international economic growth. But this agreement created two important organizations, and we know of both of them. One is the International Monetary Fund and the World Bank. So in 1970, when the Bretton Woods system was dissolved, both the IMF and World Bank have still remained strong pillars for the exchange of international currencies. Alright, and in order to take our learning further, let's first hit that like button, and if you're new, go ahead and hit the subscribe button. So let's understand what is currency pegging. Now, this is also known as a fixed exchange rate system, and under this system, a currency's value is either fixed or pegged by a monetary authority against the value of another currency. Now, typically, since all the currencies were pegged against the dollar was recognized as a strong currency, and also because the value of the dollar was pegged against gold, gold was recognized as the parent block, and all other currencies were recognized as currencies that are pegged to the value of the main dollar to gold. So the benefits of a fixed exchange rate are that it ensures stability in the currency, and it also does not change based on market conditions. And why that happens is because they're directly fixing the value of the currency with a set and predetermined ratio to a different or more stable and more internationally prevailing currency. Now, the US dollar was marked as the parent currency against which all other currencies were pegged, and that dollar was then pegged to gold. Now, let's look at a floating exchange rate as well. Now, under this exchange rate, a currency's value is allowed to fluctuate in response to foreign exchange market events, which means there's more volatility. And you might see that a lot of currencies that you know today, and including the US dollar because it was taken off of the Bretton Woods system, that all these currencies also follow the floating exchange rate. The cons are that it's more volatile and it's more subject to a change in market conditions. A pure floating currency would be the Canadian dollar, because the Canadian Central Bank has not been interfering with its price since it officially stopped doing so in 1998. And the US dollar runs a close second with very little change in its foreign reserves. You'll also notice that in contrast, Japan, the UK, they intervene to a greater extent, and India has also seen some medium range intervention by the central bank, the Reserve Bank of India. So let's go back to our initial question. Why are we talking about Bretton Woods, manipulation of currency, and the exchange rate, fixed and floating? And what does all that have to do with China manipulating its currency? Let's look at what currency manipulation is. It's a method by which a country avoids the negative effects of having a strong currency. And that's because the value of a currency actually depends on its adoption rate, which means the more it's used, the higher value it has, and the less it's used, the lower value it has, because it also determines the level of trust in a particular currency. And the more people trust a particular currency, the more it's used, and that increases its adoption rate. Now, let's understand a bit of trade also. if many countries are currently trading with China and they want to buy Chinese goods, they actually have to buy Chinese currency to trade in those goods. And because there's a lot of demand for goods from China, they'll have to buy more Chinese currency to trade, and hence the value of Chinese currency has gone up. And the problem statement here is that because it's gone up, it's also getting expensive to buy the currency and trade in that particular currency. And to tackle that and looking at the effect of that, other countries that have previously traded with China are now looking at other nations where they can conduct trade and buy cheaper currencies, which means they're exploring for more options where they can get a higher return on their money. So because the price is based on demand, because it's based on a floating exchange rate, not a fixed exchange rate model, and the currency is subject to volatility, and the prices are going up and down because of demand and supply, countries are starting to look at other nations where it's easier for them to do trade, and it's easier and cheaper for them to buy currencies. So let's start by looking at some data by the World Bank. So this is the GDP growth of China from 1961 to 2018. You can see very significant growth, especially in the early years, and it's been growing ever since. For comparison, you can also look at the GDP growth of India, once again from the World Bank, and the United States. Alright, understanding currency manipulation. Currency manipulation occurs when one currency is used to buy huge amounts of foreign currency. The US Treasury Department defines currency manipulation as when countries deliberately influence the exchange rate between their currency and the US dollar to gain unfair competitive advantage in international trade. Now let's actually see how this happens. Alright, this is the Training Economics website. We are seeing that Chinese foreign exchange reserves rose 10.23 billion to 3 trillion in May 2020, beating the market forecast of 3.081 trillion. And this has been the largest figure since February, despite a weaker one amid concerns over growing tensions between Washington and Beijing. And we're also seeing that the value of gold reserves increased to $108 billion at the end of May from 106. Now, what this actually means is that China's trying to keep the value of its currency low so that during any trade, other countries will look forward to working with China and doing business with China because it's more affordable, and not look at other options in other countries where they can get a better deal and a better return on their money. Alright, that's it for today, guys. Thank you so much for watching. If you got any value out of this video, please go ahead, hit the like button, and if you're new to the channel, subscribe. There's one other thing. These videos take a lot of time to edit and a lot of research goes into this as well. So if you did get some value out of this, just go ahead and share it with one person who you think this video can help, and it would really do well with the YouTube algorithm. So thank you so much for watching, and hit that subscribe button.